Bismillahirrahmanirrahim. This is the second video on forecasting financial statements. And in this video, we will solve exercises on how to project revenues, cost of goods sold, and inventory. We will solve an exercise on projecting property, plant, and equipment. And finally, we will identify the cost structure and projecting gross margins for capital intensive cyclical businesses. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us look into the first exercise. And here we are going to project revenues, cost of goods sold, and ending inventory. Now, use the following hypothetical data for Walgreens in 2014 and 15 to project revenues, cost of goods sold, and inventory for the next year. Assume that Walgreens next year revenue growth rate, gross profit margin growth rate, and the inventory turnover will be identical to 2015. Project the average inventory balance in the next year and use it to compute the implied ending inventory balance. So first of all, we are going to calculate the sales revenue growth rate, and the sales revenue growth rate will be equal to the sales revenue for 2015, that is 103,444 minus 76,392, that is the sales revenue for the previous year, 76,392, and this will be divided by the sales revenue of 2014, and that is 76,392. So this will be equal to 35.41%. So the sales revenue growth rate is 35.41%, and from this we can determine we can project the sales for the next year, that is 2016, and this will be equal to the sales revenue of 2015 the sales revenue of 2015, that is 103,444 times multiplied by 1.3541, and this will be equal to 140,075.68. So the projected sales for the next year will be 140,075.68. Okay, then we are going to calculate the cost of goods sold growth rate for the next year, and this is equal to the cost of goods sold for 2015, that is 76,520, minus once again the cost of goods sold for 2014, that is 54,823, and this will be divided by the cost of goods sold for the previous year, that is 54,823, and this will be equal to 39.58%. So the cost of growth rate of cost of goods sold is 39.58%, and obviously this is not a good sign because the growth in the cost of goods sold is higher than the growth rate for the sales revenue. Now from this we can determine the cost of goods sold for the year number one, that is 2016. So once again we have the cost of goods sold for 2015, that is 76,520 times 1.3958, because the growth is at the rate of 39.58%. So this will be equal to 106,803.90. So 106,803.90. Next, we are going to calculate the inventory turnover for the year 2015. Inventory turnover for the year 2015, and this will be equal to the sales revenue of 2014, that is 76,392 divided by the average inventory ending inventory, that is 8678 plus 6076 divided by 2, and this will be equal to 10.36. Okay, now from this now we can project the average inventory and the projected average inventory will be equal to the projected cost of goods sold, that is equal to 106,803.9 divided by the inventory turnover for the year 2015, that is 10.36, and this will be equal to 10299. And finally we are going to calculate the projected ending inventory balance, and for this we have the we will have the projected ending balance. This will be the projected ending inventory for is now projected average inventory is 10,299. This is the projected average, and because this is average, so we will multiply by 2 minus the beginning inventory for the year under consideration, that is year 1 number 1. Now the ending entry of 2015 will be the beginning inventory for year plus 1. So so the projected average inventory, because it is average, we multiply by 2 minus the beginning inventory for the year plus 1, that is 8678, and this will be equal to how much? Let me calculate. 10,299 times 2 minus minus 8678. This is equal to 11,920. So the projected ending inventory balance is 11,920. Okay, let us move on to the next exercise. And this is very interesting. We have to project the property, plant, and equipment. And Intel is a global leader in manufacturing microprocessors, which is very capital intensive. The production processes in microprocessor manufacturing require sophisticated technology, and the technology changes rapidly. Particularly with each new generation of microprocessor. As a consequence, production and manufacturing assets in the microprocessor industry tend to have relatively short useful life. Assume the following selected information relates to Intel's property, plant, and equipment for 2014 and 15. And we have the property, plant, and equipment. From this, we subtract the accumulated depreciation. We get the property, plant, and equipment net. We have the depreciation expense, and there is a capital expenditure of 7326. Now, assume that Intel depreciates all property, plant, and equipment using the straight line depreciation method and zero salvage value. Assume that Intel spends 6 billion on new depreciable assets in year plus 1, and does not sell or retire any property, plant, and equipment during year plus 1. So we can see that this exercise computes projected property, plant, and equipment, and it will also project depreciation expense for year plus 1 for Intel, and which is a leading manufacturer of semiconductors. So let us look into the first one. Compute the average useful life in years rounded to 2 decimals that Intel used for depreciation in 2015. Now, the the property, plant, and equipment at cost in 2014 is 79,709 and 15 is 83,396. So we will take the average plant at cost and we will divide this by the depreciation. So this will be equal to 79,709 plus 83,396 divided by 2, and this will be divided by 7821. So the average plant and equipment at cost divided by the depreciation expense. Now average plant and equipment at cost will be 79,709 plus 79,809 plus 83,396, and because this is average we have to divide by 2, and this will be divided by the depreciation expense, that is 7821, and because it has to be rounded to 2 decimal places, this will be equal to 10.43. So so the average useful life is 10.43 years. Okay. Next, we have to project the total depreciation expense for year plus one using the following steps. And the first step is project depreciation expense for year plus one on existing property, plant, and equipment at the end of 2015. Now, at the end of 2015, we have the property, plant, and equipment for 83,000. So this is part B, and this is number 1. So the property plant for 2015 is 83,396, and this is going to be divided by the life of the machine of the property, plant, and equipment, that is 10.43. So this is equal to 7,997.79. So, and then project depreciation expense on capital expenditures in year plus one, assuming that Intel takes a full year of the depreciation in the first year of service. Now, in the year one, they have spent 6 billion on the new depreciable assets. So, for number 2, this will be 6,000 divided by 10, once again the number of years, 10.43. So this is equal to 575.41. So if we calculate the total depreciation will be 8,573.20. Okay. Then we go to number 3. Sum the result of 1 and 2 to obtain the total depreciation expense for year 1, number 1 plus 1. So the total depreciation is 8573. Okay. And then we go to number C. Project the year 1 and ending balance in property, plant, and equipment both at cost and net of accumulated depreciation. Okay. So now we can have the property, plant, and equipment at cost for year number 1. And year number 1, we have made an additional investment of 6 billion, and for 2015 it was 83,396 plus 6 billion. This will be equal to 89,396, that is 83,396 plus 6,000. And then the accumulated depreciation will be the depreciation for the year 2015 plus the depreciation that we have calculated over here for 8,573.2. So this will be equal to 60,101.20. And when we subtract the net property, plant, and equipment will be 29,284.8. And the depreciation expense we have already calculated, that is 8573.20. And finally they are asking us the both at cost. So the capital expenditure at cost is going to be 600 million, 6,000 million, or you can say 6 billion. This is the at cost, property, plant, and equipment at cost for year number 1. And then the net will be, we will subtract the depreciation, and the depreciation for this 1 year was 575.41, so that is equal to that will be equal to 5424.59. Okay, let us now move on to the next exercise. AK Steel is an integrated manufacturer of high quality steel and steel products in capital intensive steel mills. AK Steel produces flat rolled carbon, stainless, and electrical steel products and carbon and stainless tubular steel products for automotive, appliance, construction, and manufacturing markets. Nucor. A Nucor manufactures more commodity level steel and steel products at the lower end of the market. Is less capital intensive mini mills. The following selected hypothetical data describes sales and cost of products sold for both firms for year 3 and 4, and these are how they have the sales and the cost and the gross profit is there for AK Steels and Nucor. Industry analysts anticipate the following annual changes in sales for the next 5 years. And what is interesting is that for the first year, there is an increase of 5%, increase of 10%, increase of 20%. But in the fourth year, there is a decrease by 10%, and in the fifth year, also, there is a decrease by 20%. Now, we are required, first of all, to estimate the variable cost as a percentage of sales. For the cost of products sold, okay, by dividing the amount of the change in the cost of products sold by the amount of the change in sales. Then multiply the variable cost percentage times sales to estimate the total variable cost. So first of all, we are going to calculate the variable cost per dollar of sales, and then we will calculate the total variable cost. Now subtract the variable cost from the total cost to estimate the fixed cost for cost of products sold. We have to calculate the fixed cost as well. Follow this procedure to estimate the manufacturing cost structure, variable cost as a percentage of sales, total variable cost, and total fixed cost. So we have to make 3 calculations. For cost of products sold for both AK Steel and Nucor in year number 4. Now discuss the structure of manufacturing cost, that is fixed versus variable. This is an interesting analysis. We will talk about it for each firm in light of the manufacturing process and type of steel produced. So first of all, let me clean up the screen, and I will be solving, making the calculations for AK Steels, and similar steps will be applied for Nucor as well. So I will give you the calculations, and you can simplify on your own. So let us go for AK Steel. AK Steel. And for AK Steel, the first thing we need to do is to calculate the variable cost per dollar of sales. And for this, we are going to, that is the change in the cost of products sold. Now, change in the cost of products sold is equal to now we have the cost of products sold as for the year number 4 as 4554. So let's take it this as A, B and C. So we go for A first of all. So the change in cost of product sold is 4554. This is the cost of product sold in the year number 4. From this we will subtract the cost of product sold in year number 3, that is 3887, and this is going to be divided by the change in sales. Now the sales was 5217 minus 4042. So this will be equal to 0.568. So for AK steel, this is equal to 0.568, and for Nucor you can use the same steps, and that will be equal to 0.613. That is the variable cost per dollar of sales. And now you can see for AK steel the variable cost per dollar of sales is less for AK steels as compared to Nucor. Then let us calculate number B, total variable cost, and total variable cost will be the variable cost per dollar of sales, that is 0.568. I have shown you how we get this value just now, multiplied by the sales for the year 2015, that is 5217, and this will be equal to 2961.48. So the total variable cost is 2961.48, and in the same way you can calculate for Nucor, and this will be 6971.78. Next we are going to calculate the total fixed cost, and the total fixed cost is equal to the total cost of product sold, and the total cost of product sold was how much? First of all, we are going the total cost of product sold is now this will be equal to 4554, the cost of product sold, minus the total variable cost, and the total variable cost we have calculated just now, that is 2961.48. So if you, from the total cost, if we subtract the total variable cost, we will get the total fixed cost, and the total fixed cost will be 1592.52. So 1592.52. And in the same way you can calculate for Nucor, and that will be equal to 2157.22. In K you can calculate as a percentage as well, as far as the now the total variable cost in terms of percentage, that will be equal to 2961.48. that is the total variable cost divided by the cost of the product sold, and the cost of product sold was 6554. So this is equal to 65.03% or 65%. And then we calculate the 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 total fixed cost percentage, and that is going to be equal to how much is the fixed cost? 1592.52 divided by the total sales total cost of product sold, that is 4554, and that is equal to 34.97%, and we can see this is equal to 100%. Now this is for AK Steels. For Nucor, the percentage for the variable cost is going to be 76.37%, and the fixed cost will be 23.63% of cost of product sold. Now these have some interesting relevance as we go for the analysis in few minutes, and we will look into it in more detail. So that's how we calculate part A. We have done the calculation part, and we go for part B, and we have to discuss the structure of manufacturing cost, that is fixed cost versus variable for each firm in the light of the manufacturing process and type of steel produced. Now, as you can see, we have already seen that AK Steels is a higher capital intensive steel mill compared to Nucor, that results in a cost structure with a larger proportion of fixed cost and a smaller portion of variable cost. You can see over here with the numbers that are displayed, and this is because the capital intensive operations often involve significant investments in machinery and facilities, which lead to substantial fixed costs that do not vary with production volume. This is the unique character of a fixed cost. In addition to its cost structure, we can see that AK Steel operates in a higher end steel. Uh, it high quality of steel in capital intensive, flat rolled. um it is Nucor is in at the lower end of the market, and AK Steel operates in the higher end of the steel market. So this positioning allows AK Steel, because they are into capital intensive and they are into higher end of the steel, so they command higher selling price for its steel and steel products. Now the higher selling price contributes to a greater gross margin, uh, which is the difference between the, you can see over here, sales minus the cost of goods sold. So due to these factors, the higher fixed cost and the premium pricing strategy, AK Steel experiences a low variable cost as a percentage of sales. You can see over here a low percentage as compared to Nucor. Uh, um, so and the same time we can see that the variable cost are expenses that change directly with the level of production or sales volume. Now AK Steel's cost structure is more fixed cost oriented. uh, we have can see from these figures. So the impact of changes in production levels on its total cost is less pronounced as compared to companies with higher proportion of variable cost. So consequently, the variable costs are a smaller percentage of sales of AK Steels. uh, and that's all I would like to talk about, and we will look into the second. So we have done part A. We have done part A and part B of this exercise, and we move on to the same exercise and we go to part C and part D. Now, using the analyst forecast of sales growth rates, now we have already determined the growth rates, 0.568, and when we have done all these calculations just now, variable cost per dollar and all. Yes, so we will be using these figures in our calculations. Rather, I will copy this. I will copy these numbers for the next page. Okay. Uh, Compute the projected sales, cost of product sold, gross profit, and gross margin, gross profit as a percentage of sales of each firm for year number 1 through 5. So I will be explaining you how to make the calculations for year number 1 and year number 4, because in year number 1 there is an increase and year number 4 is there is a decrease, and the others I will just put on the values and you can try yourself. So when we look into the sales, first of all, we need to determine the sales for year plus 1. Now sales will be what? It will be equal to the sales of year number 4, that is 5217, times, now you can see that there is a forecast, the projected there is a projected increase of 5%. So 5217 times 1.05 increases by 5%, and this will be equal to 5478. So the sales for year plus 1 will be 5217. Then we go for the variable cost, and we have seen that the variable cost is 0.568 of our total sales, and the total sales, so point variable cost 0.568 times the sales of the year, that is 5217. Oh, made a mistake here. This will be, oh, this will 5478. 5478, and this will be 0.56 times 5478. So this will be equal to 3110. The fixed cost is fixed and it is not going to change, and we have calculated it as, you can recall the fixed cost was fixed 1593. We can take it as 1593, and obviously fixed cost is fixed, it do not change, so it will remain the same whether it is an increase or decrease in the projected sales, it will not change. So the this will give us the total cost of production for year plus 1, and the total cost is the variable cost and the fixed cost, that is 4702, and the gross profit will be sales minus the total cost, that is 776, and then the gross margin percentage is going to be the gross profit 776, gross margin percentage, this will be equal to the gross profit divided by sales. So the gross profit in our case is 776 and the sales is 5478. So this will be equal to how much? This will be equal to 14.16%. Now in the same way you can make the calculation for year number 2 and 3. You can try it. I will simply substitute the values 6026, 3421, and the total cost will be 5013. The gross profit will be 1013 and the gross margin percentage is 16.80. For year number 3, the sales will be 7231, 4105 is the variable cost, total cost is 5697, and the gross profit is 1534, and this will be 21.21%. Now I am going to show you calculation for year number 4 as well, because here year number 4, because there is a 10% decrease, and let us see how we are going to do that. So now we have the sales, and the sales is going to be decreasing, and now it will be not it will be how much? There is a decrease as compared to now in year number 3 we have 7231, the sales for year number 3, and this will be multiplied by 90%. Why? Because there is a decrease of 10%. So 90% times 7231, and that is equal to 6507, 6507.69. And then in the same way, when we go for the variable cost is going to be 0.568, 0.568 times the sales, that is 6507.69. So this will be equal to, let me check, 0.568 times 6507.69. So this is 36 94, and we have here the same 1593. Fixed costs do not change, and the total cost will be how much? 75287. Gross profit will be sales minus total cost, that is 1221, and the gross margin percentage is going to be gross profit 1221 divided by sales 6507.69, So this will be equal to 18.76%. For year number 5, again there is a decrease by 20%. So you can solve accordingly. In place of 90%, it will be 80%. So it will be 5,206. This will be 2955, 4548, 658, and this will be 12.64%. So that's how we are going to make the calculations for AK Steels for the year, for the projected sales for year 1, 2, 3, 4, 5, and you can follow the same steps for Nucor as well. For your convenience or to verify your calculations, I will substitute the values. It will be 11,946, 73202157, 9478, 2468, and 20.66%. This will be 13,140, 8052, 2157, 10,210, 2931, and this is 22.30%. For year number 3, it will be 15,769, 9663, 2157, 11,820, 3948, and this will be 25.04%. For year 4, it will be 14,192, 8697, 2157, 10,854, 3338, and this will be 23.52%. For year number 5, 11,353, 6957, 2157, 9114, 2239, and 19.72%. So that's how we are going to forecast the sales, cost of product sold, variable cost, fixed cost, gross profit margin. And then we go to part D. Why do the level of variability of the gross margin percentages differ for these two firms for year 1 through year 5? And we are going to make calculations and analysis. But before we do that, I would like you to keep just one thing in mind, that in making this analysis, you must also know how to calculate the standard deviation for the gross profit margin. And for those who don't have an idea, they need to know how to calculate the standard deviation. And for this exercise, I'm not going to explain how to calculate standard deviation. You can go through any other video, or if you request, I will be making a video on how to calculate standard deviation for gross margin or sales or cost of goods sold, etc. But I have made the calculations, and the standard deviation is for Nucor is a standard deviation for AK Steels. AK Steels is 3.5%, and for Nucor it is 2.1%. So we will be using these values in explaining the analysis. So let us first of all talk about the gross margin and the standard deviation. Now for this, first of all, we need to know the average gross margin for for AK Steel, and we will simply sum up these five values for gross margin percentage and divide by 5, and this will be 16.7%. And in the case of Nucor, the gross profit margin is going to be, or the average gross profit margin will be 22.2%. That is, simply add up the 5 and divide it by 2, divided by 5, sorry, because we are taking for 5 years. So if this is the situation, so let me write down the average gross margin for AK Steel is 16.7%, and for Nucor it is 22.2%. So if you look into these, the gross profit margin and the standard deviation, they itself speak a lot about the two companies. And one of the factors we can talk about is the economies of scale and the cost structure. So you can see that Nucor, they generate a higher average gross margin. You can see 22.2% as compared to AK Steel, that is 16.7%. So despite having higher variable cost per dollar of sales and larger total fixed cost, and this can be attributed to Nucor's significantly larger scale, which allows it to benefit from the economies of scale. Now, Nucor's larger size means that its fixed costs, which do not change with production levels, are spread over a great volume of sales. Now, this lowers the average fixed cost per unit, contributing to a higher gross margin. Then, if we look into the fixed cost as the percentage of cost of production, so Nucor fixed cost was how much? Um it was almost we can say the fixed cost was almost 24% of the cost of products sold, while in the case of AK Steel the fixed cost was 35% of the cost of products sold. So Nucor's fixed costs are a smaller percentage of its total cost structure as compared to AK Steel's, and this lower proportion of fixed cost allows Nucor to manage its cost structure more effectively and maintain a higher gross profit margin. When we talk about the gross margin variability, we can see that AK Steel experiences greater variability in its gross margin, standard deviation of 3.5% as compared to Nucor 2.1%, and this higher variability in AK Steel's gross margin is due to its higher proportion of fixed cost in its cost structure. So when fixed costs are a larger component of total cost, any fluctuation in sales or production can lead to more pronounced changes in gross margin. At the same time, let us talk about economies and economies of scale also. We can talk about it. Like if you look into AK Steel, they realize greater incremental economies of scale as the sales increase. And this means that as sales grow, the fixed costs are spread over more units, improving the gross margin. AK Steel faces greater diseconomies of scale as sales decreases. You can see over here. So when the sales fall, we can see the same fixed costs are spread over fewer units, negatively impacting the gross margin. For example, if you see the sales growth rates are the same over a period of year number 1 to 3. You can see here, yes. AK Steel gross margin grows from 14% to 20%, 21% as the sales increase. And the Nucor's gross margin grows from 20.7% to 25% as such, isn't it? So this indicates that AK Steel's gross margin improves significantly with increasing sales, but also drops sharply with decreasing sales as compared to Nucor, that is reflecting its higher sensitivity to changes in sales volume due to its cost structure. So in summary, Nucor's larger scale and lower fixed cost as a percentage of total cost enables it to maintain a higher and more stable gross margin. In contrast, AK Steel's higher fixed cost resulting variability leads to greater fluctuations in gross margin based on changes in sales volume. So this completes the second video on forecasting financial statements. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.